Welcome back to Motivational Wealth, everybody. When I think about building wealth through smart investing, it really makes me think about the idea of receiving a gift. Like, it's not just about getting rich quick, but it's about receiving something valuable, something that requires us to really understand it, to nurture it, like we're tending a garden so that it can grow and flourish over time. And today, we're going deep, really deep, into the world of ETF investing. We'll be drawing wisdom from Investing Simplified by Professor G. And I'm excited to explore how we can all make more informed choices with our money, to cultivate lasting financial well-being.
Absolutely. You made a great point there. The allure, those big returns, that's what often draws people in when they first start looking at investing. They see ETFs like QQQ, VGT, VTI with these impressive average returns over the past 10 years. And yeah, some of them are quite significant. It's easy to start daydreaming about all the potential growth, right?
Oh, absolutely. But that focus on high returns, it can sometimes lead us astray. And this is where Professor G he really hits on a crucial point. He says, we need to look beyond just those headline numbers. We got to understand what we actually own within these ETFs. And that brings us to the whole issue of fund overlap. So let's unpack this a bit. Let's start with QQQ, for example, which tracks the NASDAQ 100. And as many of you know, it's heavily weighted towards technology, right? Over 50% of the fund is in tech. And you see the usual suspects at the top, like Apple, Microsoft, Amazon, those big names, NVIDIA too.
Right. And then you've got VGT, which is the Vanguard Information Technology ETF. Now this one, it's 100% tech. So while QQQ has a good chunk of its portfolio in tech, VGT is all in on tech. Unsurprisingly, you're going to see a lot of the same companies pop up in both, especially the big players like Apple and Microsoft. They make up a sizable portion of VGT.
Exactly. And Professor G, he points out that, about a third of QQQ holdings are also in VGT. But what's really important to remember here is that the weight of those overlapping holdings,
Yeah.
it can be quite substantial. So if you're holding both QQQ and VGT, you might actually be more heavily invested in a handful of those same tech companies than you realize. It's kind of like, having two bowls of fruit salad where both of them are mostly apples, right? Might have some other fruits in there, but the overall experience is still going to be very apple-centric.
Yeah, that's a great analogy. And it doesn't stop there. When you compare QQQ to something like VTI, which is a broad market ETF that aims to represent the entire U.S. stock market, you'll notice that a huge chunk of QQQ's top holdings are already present in VTI. We're talking like almost all of them.
Hmm.
So you're essentially holding many of the same companies in multiple ETFs.
The takeaway here is not that fund overlap is automatically a bad thing, right? The key is to be aware of it, to understand how it impacts your portfolio's diversification and how much exposure you have to different sectors of the market.
Yeah.
You really got to know what you own and how much of it you own. It's like making sure your financial garden has a healthy mix of different plants, not just a whole bunch of the same thing. You want to create a balanced and resilient portfolio.
Right. And this leads us to the whole diversification debate, which Professor G delves into in his book. The traditional approach has often been about minimizing that overlap as much as possible, right? To maximize diversification. Like with the classic three-fund portfolio, you've got U.S. stocks, international stocks, and bonds. The idea being that they'll each perform differently at different times, offering some balance.
But as Professor G points out, the recent performance of those international stocks like VXUS and bonds like BND, it hasn't been as strong as it has been historically. So leaning heavily on that traditional diversification model, it might not be the best path for solid growth right now.
Yeah, it's interesting to think about that in light of what Warren Buffett has famously said about diversification. His quote is, "Diversification is a protection against ignorance," meaning if you truly understand the businesses you're investing in, then spreading your money across a vast number of different companies might not be the best strategy. He's all about focusing on quality, on knowing what you're getting into rather than just trying to own as many different things as possible.
It's a thought-provoking perspective. So the way we view diversification, it's evolving, right? It's not just about having a ton of different investments. It's becoming more strategic. It's about aiming for the best possible returns over the long term, but also considering factors like safety and consistency. It's about choosing investments that you believe in, that you understand, and that align with your overall financial goals. You're not just scattering seeds randomly. You're planting them intentionally in fertile ground where you expect them to thrive.
Right. And that segues nicely into the third crucial point that Professor G emphasizes. Don't get caught up in constantly changing your investment strategy just because of, every little bit of news or the latest trends. You got to stay focused on those long-term goals. Don't be swayed by every little blip on the radar.
Exactly. And what might be a great strategy for one person, might not be the right fit for another. I mean, think about REITs, for example.
Yeah.
They can be a good option for generating dividend income. But if you already have a big chunk of your assets in real estate, adding more REITs to your portfolio might not be the best move. It might create too much concentration in one area.
Yeah, yeah. And I think the biggest mistake that Professor G cautions against is blindly copying someone else's investment moves without doing your own research, without understanding why they're making those choices and how those choices align with their specific situation and goals. Just because it works for them doesn't mean it's going to work for you.
Yeah.
And he even mentions his new 3-fund portfolio, which he details in the book, as a potential starting point for a lot of investors, suggesting that a simpler approach could be more effective than trying to overcomplicate things.
So the key takeaway for all of us is this. Just like with, any important aspect of life, you need a consistent approach, a well-informed approach, and you got to stick to your plan.
Mhm.
Don't get distracted by every shiny new thing that comes along. Those quick gains, they might be tempting, but they often come with a lot of risk. And you got to make sure you understand what you're getting into before jumping in.
Couldn't agree more. So, to our wonderful listeners, thank you for joining us on this fascinating journey into ETF investing here on Motivational Wealth. We really hope that these insights from Professor G will empower you to make informed and confident decisions about your financial future.
Building wealth, it's a journey, right? It requires knowledge, careful planning, and a commitment to staying the course, just like any meaningful endeavor in life.
And a huge thank you to all our amazing listeners for subscribing to Motivational Wealth. Your support truly means the world to us. It helps us continue bringing you these in-depth discussions to help you on your path to lasting financial well-being.
And here's a final thought for you to ponder as you continue on your journey. How can a deeper understanding of what you actually own in your investment portfolio, how can that knowledge translate into greater confidence, a sense of control, and even peace of mind as you navigate the world of finance?
That's a great question for everyone to reflect on.
Take care.